As you watch these DVDs, you will see performance numbers. The performance numbers for the Zacks rank and the back-tested strategies you'll see in these DVDs are quite spectacular, and many people's first reaction is that these returns are impossible. Well, if you'd like to understand how these returns are calculated, go to the website address displayed below. At the website, you'll learn that there is one key assumption in all of the performances that make the returns higher than you will achieve with your own portfolio. This is the assumption that the investor has no cost to buy and sell the stocks. To estimate the returns you would earn from a strategy, you'll need to deduct your trading costs from the returns. For example, if your cost of brokerage commissions are 5% per year, then you'll need to deduct 5% from the displayed returns to estimate the returns you would actually achieve using the strategies on this DVD. Even after you deduct your trading costs, though, you will soon see that the returns are truly spectacular and that when you finish these DVDs and the home study course, you will become a more effective trader. So while the Zacks rank has proven itself to be one of the best rating systems out there, the only problem with stopping at just the Zacks rank is that there's over 200 stocks ranked to number one on any given day, making it virtually impossible for most traders to trade them all. So now it's time to show you how to narrow that list of 200 plus stocks down to a smaller, more manageable number of stocks for a real-life portfolio. In this lesson, we're going to go over some of our proven profitable strategies to show you how you can really start trading the Zacks rank right away. Now, in this screen adds two additional items to the Zacks number one rank stocks. These two items, when added to the list of the Zacks number ones, not only narrows down the number of stocks to a more practical portfolio size, around 10 or 12 stocks, but it oftentimes increases its performance as well. The strategy I'm going to show you already comes loaded with the Research Wizard program, and I'm going to really get into the program in just a bit, but real quickly, if you want to retrieve any of the strategies like the filtered Zacks rank that come with the program, it's very easy to do. When you open up the program, this is what the main page looks like, and all you're going to do is you're going to go to Screen on your menu bar, then you're going to go to Open Screen Definition, and then your screen definition window pops up. I'm going to go to my SOW folder, and then I'm going to go find the filtered Zacks rank. There it is. Select it, hit open, and now it's ready to go. Now you'll see the screen has been put into your screening criteria table as well as your report definition table. But let me see if I can blow this list of parameters up so we can really take a look at what goes into this screen. There we go. Anyways, the first set of parameters, or the first item that I'm applying to the list of the number one ranked stocks, is the percent change in current quarter earnings estimates over the last 4 weeks. And I want that to be greater than 0. The Zacks rank already looks at earnings estimate revisions for the current year and the next year, but this added component looks at the more immediate future, which is the current quarter. The next item is the percent change in the average broker rating over the last 1 week, and we want this to be greater than 0 as well. This means I want there to be a positive broker rating change or an upgrade over the last week. Since broker ratings are typically skewed to the upside, I want to make sure that the brokers are getting more bullish, or at the very least, not getting less bullish or bearish on the stock. These two items added to the Zacks number one ranked stocks produce very powerful results. In fact, if you were to look at this graph, you can see this is a graph comparing the filtered Zacks rank, which generates on average of 10 stocks every time you run it, versus the full list of the Zacks number one rank, which generates on average of 200 plus stocks. As you can see, in 2002, the full Zacks rank picked up a 1.2% return. And again, this was very impressive, especially when you consider that the S&P was actually down 22.1%. but the filtered Zacks rank did spectacular, generating an 18.1% return. And again, you're only having to hold on average of 10 stocks in your portfolio at a time. In 2003, the Zacks number 1 ranked stocks did awesome. They picked up 74.7%, and the filtered Zacks rank did spectacular in its own right. It was up 66.4%. Now again, it wasn't up as much as the full Zacks rank, but again, trading 10 stocks in your portfolio is a lot easier than trying to trade 200 stocks. In 2004, the Zacks rank was up 28.8%. and the filtered Zacks rank was up 30.3%. In 2005, you can see that the Zacks rank was up 18%, and again, a very good return, especially when you consider that the S&P was up only 4.9%. But again, the filtered Zacks rank did even better than that, picking up 42.4%. And then if you look at 2006, you can see that the full list of the Zacks number 1s picked up 23.7%. But the filtered Zacks rank did even better, picking up 34.3%. And again, trading 10 stocks at a time is a lot easier than 200 stocks. So again, this is a strategy that is very easy for pretty much anybody to facilitate, because again, you're only holding on average of 10 stocks. So for a great and reliable way to trade some of the best Zacks number 1 ranked stocks, try the filtered Zacks rank and trade fewer stocks for even bigger returns. Now, trading this strategy is pretty easy. You're going to run your screen once a month, or every 4 weeks actually, and on your first week, Monday morning, you're going to buy all of the stocks that make it through your screen, which is approximately 10 stocks. Each stock would be purchased with an equal dollar amount, or in other words, an equal amount of money would be put into each stock for an equal dollar-weighted portfolio. And then you're going to hang on to those stocks for the duration of your holding period, which in this case would be 4 weeks. 4 weeks later, you're going to run the screen again, and you're going to see what stocks come through. Then you're going to keep the stocks that still qualify. You're going to sell the ones that no longer qualify, whether it be at a profit or a loss, you're going to sell them. And then you're going to buy any new stocks that newly come through, and that's it. So again, 1, you're going to run your screen on Monday morning. 2, you're going to buy any new stocks that qualify and sell the ones that don't. 3, you're going to hang on to those stocks for 4 weeks or whatever rebalancing frequency you've selected. And then 4 weeks later, you're going to do it all again. And that's it. Now, if you look off to the right, here's a basic example. Let's just say that in period 1, let's say that you ran your screen, and let's just say that 5 stocks came through. Let's say Apple, AT&T, Burger King, Reliance Steel, and Priceline all came through your screen. You're going to buy those stocks in an equal dollar-weighted manner, and you're going to hang on to those stocks for the duration of your holding period, which again would be 4 weeks. 4 weeks later, in period 2, let's just say you run your screen again. If Apple comes through, you're going to keep Apple. If AT&T comes through again, you're going to keep it. If Burger King comes through, you're going to keep Burger King as well. But if let's just say that Reliance Steel and Priceline no longer come through, you're going to sell those 2 stocks. Again, whether it be at a profit or a loss, you're going to sell them. But then if let's say 2 new stocks come through, GDI and BGC, you're going to buy GDI, which is Gardner Denver. You're going to buy BGC, which is General Cable. And then you're going to hang on to those 5 stocks for the next 4 weeks. And you're going to do this every 4 weeks, period after period after period. It's that easy. Now, for some people, 10 stocks might be too many, especially if you're just starting off with a smaller account, right? If that's the case, you can narrow it down even more, changing the operator in the last parameter, for example. Instead of just saying greater than 0, meaning there has to be an upgrade in the average broker rating, you can use the operator called top number, and you can say 5, for example, meaning now you're picking the 5 stocks with the largest average broker rating change. Now the screen will always give you just 5 stocks to hold in your portfolio at a time. And this strategy also comes loaded with the Research Wizard program, and this one is called the Filtered Zacks Rank 2. As you can see from this chart, you get the same great returns and fewer stocks. In this one, we're looking at a 5-year price performance from 2002 through 2006, and we're looking at a 4-week rebalance. This one is showing us the average return using 4 different start dates. This strategy also does great when you trade it on a weekly basis as well. As you can see, the returns are pretty spectacular, and again, having only 5 stocks makes it even easier to trade on a weekly basis. Now, the filtered Zacks rank strategies, both 1 and 2, already come preloaded with the program, so getting started is as easy as clicking your mouse. Now let's go over some of the other Zacks methods for trading as well. But before we do, let's take a look at the Research Wizard, where all of these strategies were created and where you can go and get them. All right, when you open up your program, this is the main page, and you'll see you have your title bar up on top, you have your menu bar beneath there, and then you have your title bar beneath there. On the left-hand side, you have all of your quick run buttons or your access buttons, and then in the middle, you have your categories window and your items window. All of the data within the Research Wizard is organized within these 2 windows, categories and items. Beneath there is your screening criteria table, and beneath there is your report definition table. If you want to retrieve any of these strategies that we were looking at, or if you want to retrieve any of the strategies that you've created and then saved, all you have to do is go to Screen on your menu bar, then go to Open Screen Definition, and then your Screen Definition window pops up. Go find the strategy you want to run. I've got mine in my SOW folder. And let's go find that filtered Zacks rank strategy. So we're going to select it, hit open, and now it's ready to go. If I want to see what stocks come through, all I have to do is hit Run Query. And then a list of my stocks have now popped up. I'm going to hit my back button. And let's go do another one. Let's go get that filtered Zacks rank 2 strategy. Go to Screen on our menu bar. Go to Open Screen Definition. Let's go to the SOW folder again, which is short for Screen of the Week. Double click it. Let's go find our filtered Zacks rank 2 strategy. Let's hit open. Say yes. And now this is ready to go as well. If I hit Run Query, there's my 5 stocks. Let's do one more. Let's go get our Upgrades and Revisions 2 strategy. So let's go to Screen on our menu bar. Let's go to Open Screen Definition. Let's go back to our SOW folder. And let's go find our Upgrades and Revisions 2. Select it, hit open, and now it's ready to go. Now let's see if we can take a closer look at this and take a look at all of the items that go into it. Now, this strategy is one of my favorite strategies. As the name suggests, it focuses primarily on stocks with upward earnings estimate revisions and rating upgrades. It's similar to the filtered Zacks rank, but the similarities end there. In fact, this method by far has the most hoops to jump through, and the cumulative effect it has on finding the right stocks makes it one of the most rock-solidest strategies. There's actually a few versions to this method that come loaded with the program, but I'd say this one is probably the most popular one. It generates on average of approximately 8 to 10 stocks per run. It has an excellent win ratio and has shown consistently impressive returns year after year after year. So this is where we left off. As you can see, this is the screening criteria table, so let's blow this up. Perfect, here's the parameters. Now, as you can see, the screen starts off by using the Zacks rank of a number 1. Again, only the Zacks best ranked stocks are going to be allowed through. And like we were saying earlier, with the Zacks rank proving itself to be one of the best rating systems out there, this is a great way to start things off. The next one is the percent change in current quarter estimates over the last 4 weeks. We want this to be greater than or equal to 0. Earnings with fresh upward revisions, or at the very least, no downward revisions, is what's being looked for. Next, we have the percent rating change in the average broker rating, and we're looking at this over the last 4 weeks. We want this to be greater than or equal to 0 as well. Since analysts have such a huge upside bias, again, we're going to be excluding anything that's been even remotely downgraded. Now again, the first three items so far are similar to the Zacks rank, although the operator of greater than equal to in this screen is more inclusive than the absolute operator that we used of just greater than in the other one. But again, the similarities end there. This larger list of stocks is then put through the ringer with demands from the following items. Now the next item we're using is the PE ratio, and we're using the PE using 12-month forward EPS estimates, and we want it to be less than or equal to 65. So again, we are looking at PE ratios as high as 65, so again, growth stocks are welcome, but our studies have shown that stocks with PE ratios of up to 65 outperform those with PEs of over 65. So to increase our probabilities of success, we have drawn the line at 65, but you don't have to look at extremely low PE ratios to be able to find good stocks. But anyway, 65 is where we've drawn the line. The next two items, we're looking at EPS growth. We're looking at the positive EPS growth last quarter over 1 quarter ago. And we're also looking at the positive EPS growth 1 quarter ago over 2 quarters ago. In other words, we want 2 quarters of positive EPS growth. Next, we're looking at the percent change in actual EPS, F0 over F-1. That's got to be greater than or equal to 0. So again, it's positive EPS growth last year over the year before that. And then we're also looking at the 5-year historical EPS growth rate, and that has to be greater than or equal to 17. And again, 17 sounds like a strange number, but the average stock in the Zacks universe has a 5-year historical growth rate of approximately 15%, and we want to find stocks that have a growth rate above this threshold. The next one is we're looking at the last EPS surprise. We want it to be greater than or equal to 0. So very simply, we're just saying no negative surprises are allowed. And like I mentioned earlier, companies that have recently surprised in the past have a tendency to surprise again in the future. So again, last EPS surprises has to be greater than or equal to 0. We finish it up, or one of the last items is price to sales ratio less than or equal to 4. Now, we've actually had great success with a price to sales ratio being between 2, 3, and 4. And in general, it's true that a lower price to sales ratio is better than a higher one. But for this screen, we selected 4 because it didn't narrow down the stock selection too much. Anyways, we finish it up by looking at the price, and we just simply want the price to be greater than or equal to 3. There's no real great significance for plugging this item in, but we just wanted to make sure that we weren't going to be picking any very, very cheap stocks. And if you look at all of the different items that these screens has to go through, all of these stocks have to go through, the typical price for the stock that comes through is usually right around $30 and higher. Over the last 6 years, this strategy has shown an average annualized gross return of 49.15% a year, with an average win ratio of 72%. And again, it produces on average of 8 to 10 stocks for your portfolio each month. If you look at this chart, you can see that the upgrades and revisions returns have been pretty impressive. You can see in 2001, the strategy produced a 55.8% return. This is in comparison to the S&P's 11.9. 2002, you can see that the strategy produced a 42% return. And as I power through the rest of these, you can see in 03, it showed a whopping 108.5%. 2004, it was up 49.3%. 2005, we were up 16.5. Again, it was a pretty impressive performance when you consider the S&P was up only 4.9. And then in 2006, the upgrades and revisions 2 strategy was able to show a 22.7% return. For further illustration, I ran a continuous backtest over the last 6 years, starting on January 5th of 2001 and going through 12/31 of 2006. Rebalancing the portfolio every 4 weeks and compounding the returns each period to grade or simulate how one would invest. If you were to take a look at this chart, you can see the returns again are pretty impressive. You can see that over the last 6 years, it showed over a 760% return for this strategy, whereas the S&P showed only a 19% return. Now, I'm going to see if I can open up a different chart. I want to look at a logarithmic chart. There we go. Now this is the same data, but we have a logarithmic scaling, or a log scale chart, if you will. The reason why I like log scale charts is because oftentimes when you're charting big numbers over a lengthy period of time, sometimes the earlier numbers can get so scrunched together, it almost looks as if nothing has happened. For instance, if you were to go back and you were to take a look at that period between 2001 and 2002, it almost looks as if nothing was really happening. But in fact, a lot happened. There was a 100% return there. $10,000 turned into $20,000. If you see that same time period on a log scale chart, you can clearly see that something big really did happen. You can see there was the first doubling of your investment, 10K turned into 20K. The reason why log charts are easier to read when you're looking at these big numbers is because log charts measure price performance in percentage terms. So each 100% change is the same vertical distance on the axis. So again, everything is just easier to read. So if you were to continue on with this chart, you can see a couple years later you saw a second doubling of your equity. $20,000 turned into $40,000. And then about 2 years later, you saw it happen again. You saw a third doubling of your equity, $40,000 turned into $80,000. And by the end of that 6th year, you can see that that $10,000 starting equity is now over $86,000, and there is a return of over 766% in just 6 years. So you're pretty much doubling your money every couple of years. And I think that is a great strategy. Now, trading this screen is just as easy as trading the other ones we looked at. You're going to run your screen once every 4 weeks. On Monday morning, you're going to buy all of the stocks that make it through your screen in an equal dollar-weighted manner. You're going to hang on to those stocks for the duration of your holding period, which in this case means 4 weeks. 4 weeks later, you're going to run your screen again, keeping the stocks that still qualify, selling the ones that no longer qualify, and then buying any new stock that comes through. And that's it. And since there's only 13 4-week periods in a year, you're only going to have to trade 13 times a year if that's all you want. Now, there are 2 other versions of the upgrades and revision strategy available in the Research Wizard as well. One of the versions generates on average of only 4 to 5 stocks per period as opposed to 8 to 10. All of the parameters are the same except that the Zacks rank of 1 has to be new or at least can't be more than 4 weeks old, meaning the stocks had to have a Zacks rank of a 2 or higher 4 weeks ago and have since been changed or upgraded to a Zacks number 1 within the last 4 weeks. This change will increase your turnover rate since every 4 weeks a completely new list of stocks is being generated, but you're going to have less stocks in your portfolio to begin with. This was actually the very first version of the upgrades and revision strategy that we created. We later created a second version, which was the upgrades and revisions 2 strategy, by taking out the no more than 4 weeks old item. But looking for stocks that have just become a new Zacks number 1 is a very powerful method, and we're going to be looking at how to do this in the lessons coming up. But aside from the number of stocks and the turnover rate, though, the performance results are very impressive for both. And with the smaller number of stocks, rebalancing it on a weekly basis is even easier. Now, this method uses the return on equity measure, or ROE, as one of the main components layered on top of the Zacks rank. This, too, is one of my favorite strategies and one of the most popular ones. And in a moment, you're going to see why. The return on equity item is one of the quickest ways to gauge whether a company is creating assets with investors' cash or gobbling it up. Very simply, the return on equity equals income divided by common equity. So for instance, if the ROE is 10%, then 10 cents of assets are being created for each $1 in shareholder equity. This ratio is always expressed as a percentage, and the higher the number, the better. And knowing the company is generating assets on invested capital, which includes reinvested earnings, rather than burning through it, is good to know. Anyways, let's take a look at the parameters that go into this screen. As you can see, this is basically a snapshot from the screening definition table, but this strategy starts off with a Zacks rank of a number 1. So again, we're going to be narrowing down the universe to just the Zacks number 1s. The next item we're looking at is the ROE. It has to be greater than or equal to 10. And the reason why we're looking at 10 is because the median ROE value for all of the stocks in the Zacks universe is right around 10%, so any company under this benchmark is going to get disqualified. The next item we're looking at is the price to sales ratio. Now, even though we were looking at a higher one in the other screen, in this one, we're demanding that the price to sales ratio be less than or equal to 1. Again, a low price to sales ratio, 1 and below for example, is usually thought to be of better value since the investor is paying less for each unit of sales. So if you look at the definition, it's simply price divided by sales. It tells you how much you're paying for each dollar of sales the company makes. And paying less than $1 for $1's worth of something is always a good value. The last item, or one of the last items we have here, is we want the price to be greater than or equal to $5. For good measure, we threw this in. We want to make sure the stocks are trading at a minimum of $5. Plus, too, it does have some practicality because a lot of the money managers, a lot of them won't even touch an item or a stock if it's under $5. So we just want to make sure that these picks stay on the radar screen. And then we finish it up by using this item. We're looking at the percentage of broker ratings that are strong buys, and we are saying we want only the top 5 stocks. So after all of the above items are met, this item looks for the top 5 stocks with the highest percentage of brokers rating it a strong buy. And like I said before, since broker ratings are typically skewed towards the buy side, we're going to be limiting the picks to only the ones where the brokers are the most fully on board. If you want to take a look at the results, you can see they are very impressive. And like I said, you can see why this is one of my favorite strategies. This is the return on equity strategy with an example $10,000 starting equity. We were rebalancing this on a 4-week period. And over the last 6 years, you can see that $10,000 has compounded into over $142,000 for a 1,325% gain. Pretty impressive. There's the S&P there at the bottom, 19%. Anyways, these are just a few of the Zacks Method strategies for trading. There are many more Zacks Method strategies that come loaded with the Research Wizard program, and we're going to go over even more of these a little bit later. Strategies that use different criteria to find different types of winning stocks. And any one of these proven profitable strategies can help you become a better trader immediately. Look, you don't have to live and breathe the markets or even understand everything there is to know about the markets to be able to make money in the markets. But by understanding some basic concepts and by focusing on proven methods that work, Zacks methods that work, you can become a more confident and more profitable trader right away.